Your moderator, Ryan Ruff. It's good to be back with everyone today. And as always, of course, I'm joined by private wealth advisor Homer Smith, and we're going to be diving into another wealth management related discussion as we do on the show today. And today we have a sole focus of identifying kind of a market update, if you will, to look back at what happened in June, what were some of the trends that we experienced throughout market fluctuation in June, and then, of course, what we can expect for the near future moving forward. We'll dive into Homer and his thoughts on things as well, but we have a special guest that's going to be joining us on the podcast here today, and that's Mr. Joseph Sykora. Joseph, working with Aptus Capital Advisors. We've had some of their team on the podcast here in the past, but Joseph, working in equity, he's an equity analyst. He works on portfolio reviews over there. So Joseph's going to share his feedback on, again, what we saw in June from a market standpoint, and then what we can expect moving forward. But before we bring Joseph on and get into kind of the nitty gritty of today's discussion, let's go ahead and say hi to the man of the hour. Homer, good to see you today. How you doing?
Hey, Ryan. Good to see you as always. How are you?
I'm good. I'm good. It was an eventful June. A lot going on. Before we dive into the really the fine details of everything that you guys saw and what you're looking at in the future now, give me your 2 cents on June, and then of course, obviously we've got Joseph Sykora joining us. Sykora, that is, joining us from Aptus Capital Advisors. Shed some light on how you and your relationship started with Joseph and why you felt you wanted to have him on the show today.
Yeah. June was an interesting month where we saw pretty significant moves up in the market. Pretty much all indices on the rise, and probably much higher than we had anticipated. And so I'm definitely interested to have Joseph on and get their background and ideas on what they saw, why they saw that come together. But it's been not only a great June for the markets, but it's been a really good first half of the year so far for the stock market. Very different from what we experienced last year, where we saw pretty significant negative returns both in stocks and bonds. And this year, a pretty significant recovery. Although, in speaking with Joseph recently, it was interesting to see, even with the significant returns we've seen so far this year, that when you incorporate the returns from last year as well, most of the major indices in the U.S. are still negative over the last 18 months. And so, being able to protect your capital and to protect compound returns is really what we're all about, and how we design portfolios with, definitely we want the offense on the field to be able to capture the upside of the markets. But we also want to make sure that the defense is there. And I think there's some good reason to make sure that even though everything seems calm, markets are just going up. And there's probably a lot of good reasons for that. And we'll ask Joseph about that as well. But I also think there's a lot of reasons why things might be changing in the near future, and why we need to have that defense in place. So looking forward to the discussion today for sure.
Yeah, absolutely. A lot to dig into. So with that, let's go ahead and bring Joseph out here. Joseph, good to see you today. Welcome to Advance Your Wealth.
Yeah. Pleasure to join you guys today. Thank you for having me.
Fantastic. Well, Joseph, I think the best place to start is the present. Why don't you let us know your thoughts currently on where you're seeing the market stand, and obviously we're going to look back in time, of course, at June, and then we're going to look a little forward in time. But give me your overall impressions to get us started here.
Yeah, sure. I mean, I think you can say we're halfway through the year, and most people were caught, I think, off guard a little bit. A lot of people came into 2023, sort of a continuation of 2022, pretty bearishly positioned, and the market's done nothing but go straight up. For the first several months of the year, it was led almost entirely by about 7-10 names, kind of pick your number, but basically the mega cap, mainly tech centric, large quality companies that were really just ripping higher. And then in June, you finally saw a little bit of widening out of breadth, as we say. So one example of that is that the S&P 600, which is the small cap index, actually outperformed the S&P 500, the large cap index, by a couple points on the month. So if you are wanting to see a continuation of a bull market, then you want to see things like that. You want to see it widen out, and that's what we saw in June.
So besides that, what else did you guys see in June from a technical or analytical standpoint in terms of what was driving the markets in general, and what is it that is again creating this maybe unexpected move up in the market so far this year?
Yeah, so the kind of bear case coming into the year was really put on economic macro kind of centric data. So I think a lot of macro economists out there and a lot of equity analysts were expecting to see the macro environment continuing to deteriorate in 2023. And that really just hasn't been the case. There are certainly pockets that are looking pretty weak. Like if you look at ISM manufacturing, it's been in contraction territory for, I believe, all of the year. And certainly lately it's well below 50, which is kind of the marker for expansion and contraction. But if you look at the U.S. consumer, which fuels GDP and ultimately the stock market, the consumer's been very strong. I think we can get into some of these numbers if we'd like to, but the overarching kind of summary is that the consumer still has a lot of pent-up savings and high net worth coming out of the stimulus that happened in COVID. And then on top of that, the job market has been exceptionally resilient. So the unemployment rate, we'll get an updated reading tomorrow, but it's 3.7% right now. And just this morning, you had the ADP private payroll survey come in more than double expectations. And you see the market reaction on that has become, again, a focus on what's the Fed going to do with interest rates, where kind of a good news is bad news type of situation. But that picture's been really robust year to date.
Yeah, so we're recording this for those of you watching this on Thursday, July 6th. So to Joseph's point, we just got the jobs data this morning, and as positive as that news is, we've seen market reacting negatively today. Good news, bad news, to your point, is likely means Fed is higher for longer. So, one of the things we spoke about recently was as the market was going up for most of the last decade, as the Fed was lowering rates pretty consistently, there's this constant idea of don't fight the Fed. So while there might have been other economic data points previously that pointed to challenging times ahead, if the Fed was being accommodative, that was just kind of the mantra: you can't fight the Fed. The flip side, the Fed has been pretty blatant in saying they're going to keep rates higher for longer, if not even continue to raise them. But that same attitude doesn't seem to be the case right now in terms of not fighting the Fed. What are your thoughts on that? Similar, different? What are you seeing related to the risk now, I guess, of this economic data staying stronger than people expected, the Fed needing in their minds, especially from an economic or from a employment standpoint, needing to keep rates higher? What's the risk of this? And at some point, is that don't fight the Fed going to come back to fruition again on the other side of this?
Yeah, so the Fed has been kind of laser focused on, I would say, generally speaking, two data points. So core inflation, so stripping out some of the more volatile points like energy and food. And then they've been looking at employment, because as bleak as it sounds, as long as employment is strong, it's really hard to get inflation down. If people are being able to replenish their bank accounts that they've drawn down from COVID and continue to spend like they are, then companies have pricing power and continue to push pricing higher, and it becomes a cycle. And that's what happened sort of in the 70s, and the Fed's trying to sort of eliminate this time. So they're looking at those two data points. And what they're seeing right now is a situation that's still really strong. So every time the Fed comes out and says, we expect to push rates higher, the market fades that and doesn't believe it. And then over the course of 6 weeks or whatever it takes to get to the next meeting, the market expectations inch back up to where the Fed said they were going to be, even though the Fed's been behind their own forecast in forecasting where they're going to have to end up. So after the June meeting where the Fed did not hike, they said, we expect to hike 2 more times this year. That was not priced into Fed futures at the time. And as I look at it this morning, a hike for the July meeting here in about 3 weeks is all but certain. And then another hike for some time in the duration of the year is now priced into futures as well. So until we get clear signs that inflation really is broken, it almost seems like they're going to stay out at this point, try to stay out in front of things to make sure they don't have an error on the side of letting inflation get away. They've done a pretty good job so far. Time will tell, but the stickiness of the core component of inflation is still there. So they still have work to do, so to say.
Yeah. So given where we're at, again, halfway through the year, just over it now, kind of want to break down the rest of the call today and kind of 2 different themes. One, what is the bull case? Why could this, great start to the year and one of the best years ever to start the year for the tech index, NASDAQ, why will this continue? And what are the signs pointing to that being more likely? And then what are the other side of this? What's the bear case of, hey, maybe the market's got a little bit out ahead of itself and perhaps there's trouble ahead. So let's start with the bull case. What are some of the data points and that you're seeing? And you can either pull it up on the screen or we can add it in later. But what are you seeing right now out there that is pointing to all signs go? Market's not done. We've got a lot of room to the upside from here.
Yeah. We'll start with the happy side, the bull case. And like you said, NASDAQ, best first half of the year since 1983. It was up nearly 40%, even better than 1999, which nearly doubled on the year. So we'll see if we have that type of second half. But the first half was truly exceptional. And I touched on this earlier in the call, but I think you can really summarize the bull case almost entirely by talking about the consumer. So one thing that's pretty rare, if we look back to 1990, is to see year-over-year negative change in household net worth. And we actually saw that if you look at the first quarter of 2023 versus first quarter of 2022, negative 2.4% year-over-year. So that seems like that'd be a negative point. However, if you look at the first quarter of 23 versus 3 years prior, the first quarter of 2020, household net worth is up 35%. So there is this big pent up savings, this excess savings that consumers have that they continue to draw down to the tune of increasing spending by 3 to 4% annualized, more than you would typically see given the employment environment that we're in right now. So really just a big tailwind to spending, which is fueling GDP, and then also the stock market. Companies are able to continue to press through price increases because consumers have the ability to pay for it. And kind of as a corollary to that, we touched on it again, but employment picture. There are currently, according to the JOLT survey, 9.8 million job openings versus about 6.7, somewhere in that range, unemployed people right now. So 1.4, 1.5, actually greater than that, jobs open for every person looking for a job. Now that's theoretical, obviously, and that's not a perfect match. But point being is that the employment picture is really strong. People have jobs on top of excess savings, so they've got the ability to keep spending.
Yep.
Yeah, so that's going to be your best bull case out there, and that's I think what a lot of people have missed. Coming out of October and November, where the market was so depressed, that I think they underappreciated the fact that the consumer can kind of keep this going for a while.
Yeah, and so in terms of data points, it sounds a lot potentially like the 70s, where we had relatively higher inflation, or at least bouts of higher inflation, but nominal GDP growth and wage growth was really strong. And so while all that was happening, the stock market was pretty volatile, ups and downs along the way, and it wasn't just a straight up because of that. So what's the bear case? What are the risks that are out there in spite of a strong consumer? What are some of the things you guys are seeing that still give you some pause and say, hey, yeah, there might be some support to this market from a spending standpoint, but there's some data points that are starting to pop in that might again feel the other side of this and the risks that are out there in the market?
Yeah, great question. And I would argue that the bear case, there's a lot more points for it, but they're probably not quite as strong as the bull case right now. The bull case in consumer spending is just undeniable, and it has a direct correlation with what we're seeing in the market. The bear case, we can spend all day talking about the points on that, but I think they're a little bit more anecdotal, and they just frankly haven't really mattered year to date. So first would be that a lot of them really go back to kind of the theme of margin of safety. So, Warren Buffett, the great investor, talks about investing with some sort of margin of safety, which means that if what you expect doesn't go right, are you at least paying a price that buffers you somewhat from that? And back in October, when the market bottomed, we were trading it forward 15 times on S&P 500. Now we're at 20 times forward earnings. So not exactly blow-away numbers compared to the last decade, but we also have a real 10-year rate, which is the 10-year treasury rate adjusted for inflation expectations. It's at roughly 1.8% right now, which is the highest number going back to 2008. So you talk about 15 years where we now have a higher discount rate when you think about an inflation-adjusted rate than we have in the last 15 years. So maybe 20 times is an outlandish for the last decade or so that we've seen as far as an equity market multiple, especially when you have themes like AI or whatever the case may be that's pushing markets higher. But we're doing it against a backdrop of real interest rates that are pretty punitive. And anytime you have a discount rate that is in that area, you have to think about opportunity costs. Am I going to put $1 in the equity market, or am I going to do it in something that has virtually no risk and is earning me a positive return at this point? So if you looked at a year like 2022, as real interest rates went higher, the stock market went lower, and that correlation was extremely tight. And in 2023, that's totally broken. So you've seen the equity markets grind higher, completely on the back of equity multiple expansion, not on the back of earnings getting higher at all. And they've done that in the face of real interest rates continuing to increase. In fact, today, after the job report that we got, we hit that new high that we haven't seen since 2008. We broke the previous real interest rate high that we saw earlier in the year and last year as well. So I think that's a point that we're looking at, that at some point that probably has to matter. And the second I'll touch on quickly is that, again, somewhat anecdotal, but something that propelled the market year to date that's now been pulled out has been some of the liquidity drivers. So if you've heard about quantitative easing over the last decade, it's where the Fed's buying bonds in order to pump liquidity in the market. Well, now they're doing the opposite. They have a balance sheet of bonds that they're letting roll off. These maturities roll off over time to the tune of $80 to $90 billion a month, which is the opposite of adding liquidity. It's actually taking liquidity out of the system. Well, that's the plan in order to increase tightening in the Fed's efforts to fight inflation. However, year to date, the fiscal authorities through the Treasury General account were actually adding liquidity to the system by spending down that account to near zero. And they were doing that because we had this big debt ceiling debate going on. They couldn't issue new debt, and they were having to basically spend down your bank account before, mom and dad give you another check or whatever, replenish it. Well, that was all that liquidity being put in the system was directly fighting what the Fed was doing. So now the debt limit has been extended in early June. Treasury's been issuing more bills, more bonds, and that is in turn pulling liquidity out of the system and giving some more potency to what the Fed is doing. So this is not necessarily meaningful at all in terms of what's going to happen in the equity markets. But again, it is a tailwind that we saw in the first half of the year that's now been turned into a headwind. Is it enough to make the market go down? I guess we'll see, but you add up enough of these little small data points, again, that we could kind of go on, we don't have time on. It says at some point, if things start to not go so well, then you have these headwinds in place that act as more selling pressure than maybe otherwise you would expect.
So as strong as the consumer has been, and I definitely understand the fiscal side, and there's still programs out there like the ERTC for business owners that's still providing, some of the numbers I've seen, some like 20 billion a month is coming into the pockets of business owners around the country. What are some of the concerns maybe later this year on the debt side or consumer side? And I know there's been some rulings lately around student loan payments, and there's rollovers of corporate debt and real estate debt coming later this year. From your guys' point of view, how might those play in? Again, those are still a few months away from becoming bigger issues, but how might that kind of play in similarly with this QT, quantitative tightening, the Treasury General account being refilled and taking liquidity out of the system? Will those have similar, again, add-on potentially effects where, again, it's just enough of these things coming together and they just need a spark? Maybe that spark comes from something we're not, know is coming, but there'll be kindling out there waiting for that spark. Will those impact that, do you think?
Yeah, and you brought up another one on my list that I didn't touch on, the student loan repayment. So loans haven't been having to be paid in 3 years, and now with the Supreme Court striking down the washing out the student debt, unless the Biden administration is able to do something to stall that further, which I think they probably will. But as it stands right now in September, those payments will restart up, and the average student loan payment for people that have that type of debt is $380 a month. So that's going out of whatever you were going to spend that on going out to eat or buying the new iPhone or whatever it is, and it's going into debt repayment. So again, that's kind of the death by 1,000 cuts. You bring up a good point there, but I think it's all about jobs going forward. If the bear case really does play out, it's going to require there to be some unfortunately some pain, at the household level, which is going to start with jobs becoming layoffs becoming more common. One thing that we've looked at on the bear case is lending standards. So if you look at it's called the SLOOS. It's the Senior Loan Officer Opinion Survey. It measures tightening in credit at the bank level, and it has a strong correlation with unemployment. And right now we've seen, again, those two kind of diverge like so many other metrics that typically have high correlation, where lending standards have gotten much tighter, but the employment picture hasn't shown any cracks yet. So I think it really has to do with the employment overall picture. If that starts to weaken substantially, then what's going to happen is that all that excess savings that people have is going to be spent down. Then you're in a situation where you have to kind of tighten your bootstraps. Companies will no longer be able to support price increases at the top line. That flows through to earnings, and with margins getting tighter by the day. And there you go. And that's where you get the adjustments in earnings, which we've already been seeing so far. So if you look at 2023 earnings for the S&P, last summer, so this time last year, they were at $245, and now they're at $220. So they're down 12% year over year, but that could have more to go if we see weakness in the job market. So definitely looking at that closely in the next 6 months.
All right, so lots to keep our eyes on, and I think the conversation today really highlights the kind of our shared philosophy, Convergent Aptus, of pairing a good offense with a good defense, and that while there's enough bear case out there to believe that this could or should already be happening. I can't remember if it's a Buffett thing or some other saying, but the markets can go up longer than you can stay solvent, or be irrational longer than you can stay solvent. And so even though it doesn't seem necessarily rational given all the other data out there, markets potentially are going to could keep going up. So we want to make sure we have offense on the field, but we need to have the defenders there as well, that if all of the culmination of all these other data points together do come to fruition, that we're not, caught off sides and aren't prepared for what might come.
Yeah. One thing we were talking about yesterday is that the very definition of volatility is that it's unexpected. Otherwise you'd be prepared for it and it wouldn't create volatility. So I think you're exactly right in terms of portfolio construction. I think what we're doing differently is that we're embedding that as part of a core holding in portfolios, making you prepared for things that you otherwise can't time. If you could, you wouldn't be investing. I mean, you'd be investing your own money and a lot of other people's. Point being, it really can't be done. That's why we embed that in the portfolio, but still have upside drivers that can participate in years like this.
Yeah. We can't predict the future, but we can prepare for what might come. So, Joseph, thank you. Appreciate your time. Ryan, any words from you as we let Joseph go for the day?
Yeah, no, appreciate you, Joseph, and your insight into the matter. Homer, look, we've covered a lot today. Obviously, there is some interesting things on the horizon that we're going to keep our eye on. But for anybody out there, Homer, that would benefit from a conversation, maybe let's say with you and your team, just to talk about where their portfolio might sit and how it could be impacted in the months to come, what would be the best way they can get in touch with you guys?
Yeah, we'd love to have them reach out, to us through the website. Can email us directly, and we'll have that up on the screen here. But really, what our job for our clients to do is, when we first meet with a client in all areas of their financial world, is to take an overall big picture view of it, identify if there's any gaps or opportunities, and present you with the options along with the pros and cons. And then we're very confident you can make a smart decision on where to take that from there. So related to your portfolio, we're assuming, you probably had a good year in the market. If you've been very market oriented in your portfolio and aggressive, might be worth a second look on, okay, what should we be doing and thinking about now? And that, if we're getting near the end of this run up and that we've seen this year, what are some things you can do in your portfolio to add some defense in and protect from potential declines from here? So again, we're not predicting that, but again, if it were to come, are you prepared for that? So I'd love to have a second pair of eyes in your portfolio and give you some thoughts on that.
Fantastic. Well, Homer and Joseph, appreciate you guys both for carving some time out of your day to jump on and dive into, of course, the past quarter, and then obviously looking forward. We'll let you guys get back to serving your clients and doing what you do best, but appreciate you both. And Joseph, maybe we'll have to have you back on down the road to dive into another market update.
Yeah, would love to. Thanks, guys.
Thanks, Joseph.
Yeah.
Thanks,
Of
Brian.
course, of course. And hey, look, folks, we're going to take one final moment as we always do. And thank you for stopping by and spending some time with us on the show today. If you did take anything away from today's discussion on the market update and you benefited from the show, go ahead and hit that subscribe button on whichever platform you checked us out on today. That way you never miss out on a future episode where Homer, myself, maybe one of our esteemed guests, we dive into these different wealth management topics so that you and yours can come out with some value on the other end. Before Homer and Joseph, I'm Ryan. We're going to go ahead and say so long, but we appreciate you stopping by and being with us on Advance Your Wealth.